Investing in debt and rescue funds, beware. Many deals from 2021 and 2022 are doomed. Make sure that your money is not going to these pre-2022 vintage deals. A little bit of warning, you guys have sent me some emails. There are some debt funds and rescue funds out there, and all I gotta say is just be careful with those types of investments. A lot of those deals won't make it unless cap rates come back from 6.5 down to the low 5% in 2 to 3 years. You're seeing a lot of desperate things that a lot of people are doing. They're selling off their personal houses. They're getting a lot of these capital fund raisers to jump into these deals to fortify these deals. All I gotta say, if you're an investor and you're investing in one of these blind pool funds, these debt funds, rescue funds, just make sure you know where the money is going. Be very wary of the money going to deals that were entered in prior to this correction. So if that deal was purchased with 2021 or 2022 bases. Why? Because after 2023, the bases dropped down about a third. So a lot of those deals are quite frankly screwed. You just bought at the wrong time. What these operators are doing is they're taking in these debt funds, these rescue funds to just prop up those deals. But ultimately, the new money in, which would be you, there's not much to gain there because the properties just were bought at the wrong time, unfortunately. I'm not saying that all debt funds or rescue funds are bad here. If those monies are going to specific deals where it's entered in after the correction, late 2023, certainly 2024 projects or later, that's fine. The problem is for investors out there, it's really hard to determine where money is actually going to, and that is up to the operator's discretion per the PPM. So again, there is definitely a binary effect going on here. Old deals, don't waste your time on it. They've got the kiss of death at this point. They're just bought at the wrong basis. But new deals are amazing, and you want to put fresh money into new deals where the evaluations have already been refreshed and you're buying it at better basis. This gets mixed up in the marketing shuffle out there. So I just wanted to put that out because I've seen investors blindly go into these so-called diversified funds, but that fund is just a bunch of old stuff. The stock market has been performing very well despite the persistent high interest rates. It seems like the current stock market prices already factored in future rate cuts. And if that's correct, it's going to make the stock market even more overvalued than it really is today. And this isn't limited to stocks. Junk bond prices have risen and yield spreads over the T-bills have narrowed, signaling that investors perceive lower risk and are willing to pay higher prices. Additionally, gold, silver, and cryptocurrencies are up, contributing to what are some calling the everything rally. We enter in this frothy or euphoric zone. This is where we were in 2021 in commercial real estate. What you're seeing is this phenomenon where the financial sector and the housing sector went through its trough, but all the other friends in the stock market world, cryptocurrencies, haven't gone through this correction yet. And this is a time where there's high complacency and momentum investing. If you're somebody out there who likes to rebalance your portfolio, you're seeing this very clearly. Now, it's crucial for investors to return back to the principles and rebalance their portfolios that are currently undervalued, like commercial real estate, and rebalance with some of your frothy stuff, like your cryptos, stocks, bonds, mutual funds, or stuff in your 401k. Over the past couple of years, we've seen the Federal Reserve increase rates to these really high levels. Now the theme is higher for longer. And this has led to valuation corrections, and multifamily real estate is down about 20% on average from the 2022 peak. Now, some regions are even down 30 to 40%, specifically Phoenix or Atlanta. Other parts of the country even are down 10 to 15%. So it's across the board. It's a national thing. From a value investing perspective, commercial real estate is low, especially multifamily, trading at a significant discount to construction and reconstruction costs. We all know the long-term trends that we're becoming a nation of renters, and that once this supply burns off these next couple of years, the rent should start to pick up again. People need a place to live long term. And then we always say, invest in long-term trends. Things are going to be around for longer than 10 years. And multifamily is one of those things, particularly affordable housing. Why did it go down so much? Commercial real estate heavily depends on financing. Currently, bank financing is super tight. Banks have difficulty lending even at 55 to 65% loan to value or LTV. Compare this with a couple of years ago where the standard was 75 to 80% of LTV. Now, this shift makes it difficult for buyers of commercial assets, and we put ourselves in this camp. This is why we haven't bought anything since the summer of 2022 because we just couldn't make the deals work. But since then, the prices have come down drastically. If your money is going to be put into a fund that's going to be investing into a deal that was done prior to the correction or 2021, 22 vintage type of deal, remember those properties were bought at a higher basis. The kiss of death is right there. And you don't want to be putting your money into old deals with higher bases. Instead, we've already seen the bases come down. So go into fresh new deals where you're paying 30% less. It just makes total sense. But again, it's tricky when you kind of get mixed up in the marketing fluff of all these debt funds and rescue funds out there. This is why we are targeting just brand new acquisitions where we can get fresh new debt, fixed rate debt. Now, to close this out, while the stock market's future is uncertain and asset values like in Bitcoin and gold appear higher right now, just know that commercial real estate is trading at a significant discount today. We know rate cuts will eventually come into the later part of this year and providing a great tailwind to many commercial real estate projects. That said, if you're not in the water now, you're not going to get a part of that wave. As a seller myself of commercial assets, I know once that switch is flipped, I'm going to command much higher pricing at that point. If you're a buyer looking to invest, you need to get established in projects now that have good debt service coverage ratios so you're in the water catching that wave. And the lower rates and the looser credit conditions, such as maybe higher LTVs, could significantly boost commercial real estate prices, where we're going to start to see those cap rates start to compress downwards, which means a lot of great market appreciation for those of us who are in established assets now. You invest in a deal based on existing financials, but it's always nice to get that cherry on top of the cake or this cap rate compression to get downward as interest rates come down too. And I think what we all understand is inflation is going to come back here. Supply is going to come back down, meaning there's going to be less competition for multifamily assets, and that will generally push rents higher and multifamily prices higher. So a lot of great tailwinds coming. But again, take a look at your portfolio and you may have to start rebalancing.